Bloomberg, we believe in the power of ideas. That's why we launched Bloomberg New Economy Catalyst. It's a community of global leaders and innovators who are blazing new trails to transform business and government. This platform will help them share their ideas with the world and provide access to the resources they need to bring them to life. Bold thinking, breakthrough action, Bloomberg New Economy Catalyst. Ideas are the foundation of the future, and building on them requires capital. At Bloomberg New Economy, we create networks that mobilize capital, financial capital, human capital, intellectual capital, and social capital. Because the promise of the new economy is bigger than financial rewards, the promise is a more inclusive and sustainable future.
About 2 minutes to the start of India's trading day. We have some stability in the markets. Nifty futures pointing to a higher open, up 0.4%. Now, Indian debt traders are gearing up for a crucial week as the central bank reviews policy and the outcome of a global bond index review falls due.
Well, later today, the RBI saying state governments will auction bonds worth around about $3.4 billion US. The result of FTSE Russell's index review is due Thursday. We've got any announcement of India's inclusion expected to propel further gains in rupee securities.
And if that's not enough, on Friday, a Reserve Bank of India meeting may yield clues on the rate outlook with an increase in borrowing costs largely priced in for the week.
Madhavi Arora is lead economist at Emkay Global. Madhavi, welcome to the program. You are saying it's a very crucial week for the bond market. Walk us through what's making it crucial and what the RBI will be looking at in particular in your view.
The week ahead actually is quite crucial for bonds. I mean, there's a lot in store, starting with the fact that, the market is now repricing Fed's terminal rate, which obviously has had a rub-off in Indian bond market as well. And, INR is along with that. And consequently, obviously, it will have a reaction impact on the RBI's reaction function. So that itself is sort of, resetting the market expectation. We also have the borrowing calendar for second half of the year. And of course, the market is closely watching any development with regard to the JP Morgan index inclusion, which could be, probably released any time in the next 15 days or so.
Madhavi, people have been saying that, this is a game changer, being this bond inclusion story here as well. But, how will it change, do you think, the structure of the bond market there in India as a consequence?
See, at this point in time, foreign ownership of Indian bonds is less than 2%, as against our, open limits of around close to 6%. If that index inclusion actually happens, the ownership of foreign investors could increase to as high as 10%, but that will happen over a staggered period. And of course, at this point in time, most market participants were trying to front run the story, which I don't think has really played out for a very long time. And now we are, seeing the enthusiasm also taper to some extent. But nonetheless, I think it's just a matter of time that we are part of the index. If not this quarter, maybe next quarter or so. But the passive flows will come with a staggered move, and it would be at least probably 1.5 years to the extent that we can get a 10% weight in the JP Morgan index. But nonetheless, it will obviously, improve the capital inflows in the economy, especially in the bond segment, and to that extent, lower the capital cost for us as well.
Madhavi, you got to wonder, what if that inclusion does not happen? So much has been priced into that.
See, again, as I said, it's a matter of time that it happens. India is a very important market. They can't be including it for a very long period of time. There are still operational issues that they're working on, but my sense is that, if not this quarter, as I said, it would ideally be there by next year or sometime mid next year. But I doubt that they would be excluding India. There's a lot. Yeah, there's a lot that has happened in terms of policy discussions, and my sense is that it's there in store for us.
So just a matter of time. Of course, all eyes on the RBI and that move on Friday. Expectations are increasingly it will move 50 basis points. What's your take on that?
Well, do we have a choice now? I mean, the kind of robust repricing that is happening in developed markets, and that is sort of strong-arming the emerging markets as well. A lot has changed since the August policy. I think the markets globally was a little complacent on the Fed repricing, which is obviously now pushing all the emerging markets to tighten their policy stance, of course, to also take care of the financial sector volatility that is coming their way. So I think we don't have much choice on that front. Even though India is pretty much used to the 6-7% inflation, it's not something new for us. It's the Western world which is struggling with the same. Nor did we see the kind of fiscal stimulus that the West has given to their economies. But we are, as I said, we are sort of getting strong-armed by the developed markets and the kind of sharp repricing that is happening, in the DM policy stance, which obviously has implications for our asset classes and thus to be able to, probably offer a fair term premium, so to say. I think emerging markets are not having much of a choice. So I think 50 bips is a given. If they do a 35 bips, it probably would be a more signaling mechanism for growth. But I think that will cost them much more in terms of the volatility that could bring on in the financial market. So I think it's safer for the Reserve Bank to go for 50 than for 35 at this point in time.
Madhavi, the thing is, as you said, being strong-armed by developed countries, the Indian economy seems to be doing okay. Is the danger here that by being strong-armed, they actually start to derail it?
Yeah, so see, to that extent, of course, if India is doing relatively well because of better domestic dynamics, it also has a cost in terms of external sector because the current account tends to shoot up then. So that, I think, is the reason why rupee is getting pressured. And RBI finally has let the rupee go because clearly it was a lost battle for them.
Before we let you go, Madhavi, inflation, why has it been so sticky? Despite the fact that we're seeing, commodity prices easing, including oil?
I think it's to do with the fact that service inflation is, still sort of service is coming off in terms of, it's increasing consumption service sector. So my sense is that the core inflation bit is anyway has been sticky. We are still around 6% plus on that front. Food inflation, even though has come off, but the recent, spike in vegetable prices also keeping the food inflation high. And I think the next quarter also would see core inflation being extremely sticky, something that we're seeing in the rest of the world as well, where while core goods inflation is coming off, core services inflation is still, probably going up the ladder because the world is now moving away from goods to services. So that kind of normalization is impacting the service inflation, which is, I think, a same phenomena that we're seeing in the rest of the world. So it's not very different for India.
Madhavi, thank you. Madhavi Arora.